Welcome to vTalkInsight, Allocator's Lens Daily for January 6th, 2026. We start the year with a rare mix of cooling job data, stubborn inflation, and rising geopolitical tension, yet both risk assets and safe havens are rallying. For allocators, the key question is how artificial intelligence, spending, Federal Reserve timing, and the Venezuela shock interact across equities, bonds, currencies, and commodities. In equities, markets are leaning into an earnings-driven upswing even as macro risks build in the background. The S&P 500 is grinding higher, and the volatility index is below 15, signaling confidence that recent geopolitical shocks remain contained. Strategists looking out over the year see upside, anchored in profit growth rather than multiple expansion. One prominent roadmap envisages the S&P eventually reaching around 7,700, with an even higher target toward decade end, but also flags the possibility of a mid-teens drawdown along the way. Earnings per share estimates near 310, implying roughly 15% growth, leave little margin for disappointment and suggest choppier price action if companies miss that bar. Beneath the index level, artificial intelligence remains the dominant growth engine. Hardware and core infrastructure names like NVIDIA and Microsoft are seen as long-duration beneficiaries, with some expecting 2 to 3 more years of AI-led outperformance and the Nasdaq beating broad equities by more than 10% annually. NVIDIA is a focal point, with revenue growth this year projected to exceed consensus by a wide margin, potentially above 65%. Its new Vera Rubin platform promises an order of magnitude reduction in inference costs versus the prior generation, and the company is pushing into physical AI, including robotics and autonomous systems. That combination of innovation and heavy demand supports a view that the broader $1 trillion AI infrastructure build through 2028 will keep semiconductor earnings elevated, even as software faces disruption risk and relative underperformance. At the same time, leadership is slowly broadening beyond megacap tech. Investors are rotating towards sectors with lower valuations and improving fundamentals, notably energy, healthcare, financials, and industrials. Healthcare screens as attractively priced with positive earnings revisions, yet many portfolios remain underweight, leaving room for incremental allocation. In energy, valuations lag even under scenarios where crude falls toward $40 and service and drilling stocks have already outpaced the S&P since late summer. Financials are another key pillar. Bank earnings are projected to climb at least 30% over the next 3 years, helped by deregulation and, for some names like Citigroup, the prospect of exiting regulatory constraints. Small caps also feature in the pro-cyclical story, with expectations that eventual rate cuts, better earnings, and merger activity could unlock further gains. Internationally, Asian and European tech is in focus. Strong moves in indices like the Kospi and Nikkei, plus an upgraded outlook for TSMC, have pushed regional benchmarks to new highs. That, together with flows into equal-weighted S&P strategies, signals an equity market slowly rotating from narrow AI leadership toward a more diversified, but still growth-oriented, mix. Turning to rates, the dominant theme is a tug-of-war between a softer labor market and stubborn inflation. The unemployment rate has moved up to about 4.6%, and firms report slower hiring, pointing to a gradual cooling in demand for workers. Yet inflation is still running above target, with tariff policy adding an estimated 30 to 50 basis points to price levels and keeping underlying inflation in the mid-2% range. Against that backdrop, the Federal Reserve is broadly seen as sitting near neutral and likely to hold policy steady at the upcoming meeting. Officials are signaling that the trajectory of unemployment will be critical for any shift toward cuts, but they are also wary of endorsing easier policy while inflation remains uncomfortably high. Market pricing leans toward the first rate cuts from mid-year, while some voices warn that if growth and inflation stay resilient, the Fed might delay easing into 2026. For the Treasury curve, that uncertainty translates into a complex mix of carry and term premium risk. The steepening trade has been in place for some time, but the next phase is less clear as investors balance expectations of lower front-end yields against concerns about long-term supply. Base case projections have the 10-year yield drifting toward roughly 3.75% over the next couple of years, with fixed income total returns in the high single digits, largely driven by coupon income rather than big price gains. Treasury inflation-protected securities are highlighted as offering positive real yields above projected inflation, and municipal bond screen as cheap on a tax-adjusted basis after heavy issuance. The risk scenario is one where U.S. growth holds above 4% and inflation stays in the upper 2% range. In that world, long-end yields could push higher than current forward curves imply. Supply and fiscal dynamics complicate the picture further. Rising interest costs, now exceeding $1 trillion annually, and potential funding needs for large-scale AI-related infrastructure raise questions about how much additional duration the market can absorb without higher-term premia. There is also concern that heavy back-end issuance could trigger bouts of stress reminiscent of past episodes when the yield curve cheapened abruptly. Adding to that, U.S. long yields moved lower through 2025 even as other developed markets saw stable or rising rates, hinting at idiosyncratic factors such as political pressure for easier policy. Looking forward, a more independent federal open market committee, with less sway from the chair, is expected to resist aggressive easing. Many observers doubt that policy will be cut far below 3% absent a clear downturn. For multi-asset allocators, that combination argues for close monitoring of upcoming labor and inflation data, because each surprise has the potential to reprice both the curve and equity valuations at the same time. In credit, the message is one of relatively full valuations running into a sizable supply calendar. Spreads remain tight by historical standards, even as some metrics of underlying fundamentals have stopped improving. A leading dealer expects roughly $1 trillion of net U.S. investment-grade issuance this year, with a large share linked to AI infrastructure and other capital-intensive projects. That volume could put upward pressure on spreads simply by increasing the amount of paper investors need to digest, especially if demand does not keep pace. It also underpins the view from some houses that U.S. equities may outpace U.S. credit, as earnings growth and eventual rate cuts support stocks, while corporate bonds contend with limited room for further spread compression. On the positive side, the fact that much of the new borrowing is coming from highly rated, cash-generative issuers suggests the current credit cycle could extend rather than abruptly roll over. Within sectors, banks and emerging special situations stand out. U.S. bank earnings are projected to grow by at least 30% over the next 3 years, helped by deregulation and improving capital flexibility. That backdrop is constructive for both equity and credit investors in the sector, although it also raises questions around future risk-taking. Citigroup's expected exit from regulatory constraints by 2026 is seen as a catalyst for better returns and potentially tighter spreads on its debt. In emerging markets, Venezuela is drawing fresh attention after the recent political shift. Hedge funds are actively exploring opportunities, encouraged by legal analysis that sees a low probability of outright debt repudiation. The base case for restructuring appears to involve maturity extensions and alternative payment instruments rather than deep principal haircuts, and medium-term growth projections that take Venezuelan GDP from under $100 billion toward the low hundreds of billions could improve debt sustainability. Even so, complex entanglements with Russian and Chinese creditors, the need for around $100 billion in infrastructure investment, and ongoing sanctions mean this remains a high-risk, highly path-dependent credit story. Foreign exchange markets sit at the intersection of de-dollarization narratives and policy divergence. One prominent call looks for another sharp leg lower in the U.S. dollar by the middle of 2026, arguing that repeated domestic risk events have weakened its safe haven status. Foreign investors hold around $33 trillion in U.S. assets, so even modest shifts toward hedging or diversification could translate into several $1 trillion of potential outflows over time. At the same time, interest rate cycles are expected to diverge. The Fed is seen cutting policy rates while some other central banks may still be tightening, complicating carry and funding decisions. Despite a broad consensus for a softer dollar over the year, trading is likely to be volatile as positioning adjusts to each macro and geopolitical headline. The recent pattern of both the dollar and gold strengthening alongside equities underlines how unusual this environment is for currency allocators. Digital assets add another layer to the currency story. Bitcoin has surged back above $90,000, gaining more than 2.5% and reclaiming its 50-day moving average, with Ethereum and other majors also advancing. Flows into exchange-traded products tied to growth themes such as artificial intelligence, income overlays like covered calls, and alternatives including Bitcoin and precious metals highlight investors' appetite for differentiated return streams. Institutional participation in crypto is rising month after month, supported by progress on U.S. market structure legislation that aims to provide clearer rules for both traditional and digital firms. At the same time, the main settlement utility in U.S. markets is moving to tokenized treasuries, equities, municipal bonds, and corporate debt, effectively putting core securities on a crypto rails at scale. For allocators, that evolution tightens the link between FX, rates, and digital assets, and helps explain why some portfolios now pair traditional currency positions with targeted exposure to regulated crypto vehicles. Commodities round out the picture, starting with gold. The metal continues to trade with a firm tone, supported by diversification away from the dollar and heightened geopolitical risk. Central banks are expected to remain net buyers, partly as they seek to reduce reliance on U.S. assets amid tensions around sanctions and reserve security. Some analysts now discuss price paths that could take gold well above $4,000 per ounce over time, with upside scenarios even higher if confidence in the dollar's safe haven role erodes further. What is striking in recent weeks is that both gold and the dollar have been strong at the same time, a pattern that signals broad demand for perceived safety rather than a simple anti-dollar trade. That reinforces gold's role as a portfolio hedge alongside, rather than instead of, U.S. cash and treasuries. Oil markets are dealing with overlapping shocks. The capture and extradition of Venezuela's former leader marks a major geopolitical shift and raises the prospect of greater U.S. influence over one of the world's largest heavy crude reserves. U.S. majors with existing exposure, notably Chevron, have already outperformed on expectations of future access, even as management teams remain cautious about committing large sums before the political and fiscal framework is clearer. Yet spot crude prices remain relatively subdued. Markets are focused on current global oversupply, OPEC Plus maintaining quotas, and a reality that meaningful increases in Venezuelan output will likely take years given degraded infrastructure and the need for $10 to $15 billion in near-term investment and much more over the decade. Additional Venezuelan supply is expected mainly to weigh on the back of the curve, helping to flatten it. The recent rally in Brent looks driven in part by a short squeeze, with speculative shorts at multi-year highs. Looking ahead, underinvestment in oil infrastructure more broadly raises the risk of tighter balances later in the decade, and that tension helps explain why energy equities and oil service names have been outperforming even in a soft price tape. Beyond oil and gold, industrial and strategic metals are becoming more central in institutional portfolios. Copper prices are benefiting from the AI and data center build-out, particularly in Asia and Europe, as well as from the energy transition and precautionary stockpiling ahead of potential tariff changes. There is an important caveat. If the rally in AI-related equities were to stall, some of that demand narrative and price support for copper could come under pressure. Nuclear fuel is another emerging theme. Producers rallied after the U.S. committed billions of dollars to restart domestic uranium enrichment, sending names like Centrus Energy sharply higher. More broadly, rising resource nationalism across major powers, including the United States, China, and Russia, is expected to push commodities to a larger structural weight in institutional portfolios. That intersects with equities through miners and energy companies and with inflation hedging, reinforcing the idea that real assets will be a key part of managing both growth opportunities and geopolitical risk in the current cycle. Stepping back, the cross-asset picture shows an economy still supported by AI-driven capital spending and solid earnings expectations, but facing a cooler labor market, sticky inflation, and rising geopolitical strain. Equities lean on profit growth and sector rotation beyond megacap tech, while rates markets grapple with when and how far the Fed can ease without reigniting inflation or losing control of term premia. Credit carries tight spreads into a heavy issuance pipeline, even as selected special situations like Venezuela attract opportunistic capital. In currencies, the dollar sits between de-dollarization narratives and policy divergence, just as crypto adoption and tokenization deepen the links between digital and traditional assets. Commodities, led by gold, energy, copper, and uranium, are increasingly central as both growth proxies and hedges against geopolitical and inflation shocks. For allocators, the key watch points now are incoming labor and inflation data, Fed communication around mid-year, the evolution of AI investment and earnings delivery, and any further escalation around Venezuela or Iran that could reshape energy markets and the dollar. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.